Hi everyone, Daniel Later here with Later CPA and Associates. Today, I want to share a tax strategy many private practice owners don't use enough: paying wages to your own children. It might surprise you, but paying your kids can lower your family's overall tax bill. How much you save depends on your business structure. In this video, I'll walk you through two common setups. One for an S corporation and one for a sole proprietorship. I'll show you the numbers and explain why the savings look different based on your business type. Here's why paying your kids can save money. The IRS lets you pay your children for real work in your business. If the wages are reasonable, you can count them as a business expense. Plus, if your kids earn less than the standard deduction, which is $15,750 for 2025, they usually don't owe federal income tax. This helps move some income from your higher tax bracket to your kids, who likely owe little or no tax. That lowers your family's total tax bill. Let's set up the example. Your business made $100,000 net income before paying kids. You have two children under 18 years old, and you pay each $15,750, the 2025 standard deduction. Both parents are in the 24% federal tax bracket. We're only talking federal taxes here, no state taxes. We got to keep it simple somehow. The kids won't owe federal income tax because they earn less than the standard deduction, and no income taxes will be withheld from their wages. Scenario 1, a sole proprietorship paying kids. If you're a sole proprietor and you pay your two kids $15,750 each, that's $31,500 total. Since the IRS doesn't require payroll taxes on wages paid to kids under 18 for sole proprietors, you won't pay Social Security, Medicare, or federal unemployment taxes on that $31,500. So what does that mean? You get a lower taxable income by $31,500. So instead of paying taxes on $100,000, you pay taxes on $68,500. At 24%, that's $16,440 in federal income tax. Without paying wages to your kids, you'd pay $24,000. That means you save exactly $7,560. Scenario 2, an S corporation paying kids. Now let's say your business is an S corporation and you pay your two kids a total of $31,500, just like on the other scenario. You lower your taxable income by the $31,500 in wages, plus about $2,410 for the employer's share of payroll taxes. That brings your taxable income down to about $66,090. At 24%, your income tax is about $15,860, but the S Corp has to pay the full payroll taxes on those wages. The Social Security and Medicare and a little bit of federal unemployment, that's a little more than 15.3% of taxes. 7.65% for the employer, 7.65% for the employee. So 15.3% of $31,500, or about $4,820. So after adding payroll taxes, your total tax bill is about $20,680. That's still a solid savings compared to the $24,000 you'd pay if you didn't pay wages to your kids. So to sum it up, as a sole proprietor, paying your kids $31,500 saves you about $7,560 in federal taxes because you avoid payroll taxes on those wages. As an S corporation, you still save money, about $3,320, but less because of payroll taxes, even with the deduction from the employer's share. So paying your kids can save money either way. It depends on how your business has already been set up. Now here's a little bonus insight too. This tax benefit of paying your kids grows if you are in a higher tax bracket. For example, exact same scenario, but now your family is in the 32% tax bracket. Paying your kids' wages could save you about $10,080 if you're a sole proprietor, or around $6,030 if you're an S corporation. Now what can your kids do with their wages? Well, I remember when I was a kid, I would have loved $15,000 every year from my parents. So I don't think your kids will have a hard time figuring out what to do. But as parents, you can help guide them in a better direction on what to do with their money. The money they earn can be used in smart ways. And because you deduct those wages as a business expense, it's almost like those options become fully tax deductible to your family. Your kids can use their wages to start investing in a Roth IRA. That will help them build tax-free retirement savings from early on. Plus, it's building off of tax-free income for them. A double benefit. They can save for college, putting money aside for future education costs. They can pay for a family vacation, like a trip to Disneyland, creating lasting memories and fully tax deductible. Also, they can also launch their own business. They can use their wages as seed money to start their own little venture. Because your business deducts their wages, you're effectively turning these personal goals into tax-smart moves that benefit the whole family. Before you start paying your kids or restructuring your business, keep a few things in mind. The work your kids do should be real and their wages fair. The IRS may disallow deductions if it looks like a tax dodge. Keep good records like timesheets and pay stubs with details about their work. Put them through a payroll service. Do it properly. It will cost a little bit, but you'll know it's done properly and correctly. Check with your CPA to make sure this strategy fits with your tax situation, especially if you have more complex tax needs or state taxes. Our scenarios that we ran through are very simplified versions of this tax strategy. No one lives in a bubble, so talk with your CPA and see what they say about this strategy for you. Thanks for watching. Paying your kids can be a smart tax move. If you want help with this or other tax strategies for your private practice, contact me at Later CPA and Associates. That's latercpa.com. Don't forget to subscribe, follow, hit the bell for more tax tips for mental health practitioners. I'll see you next time. Bye.